In this video, we're going to look at accounting for prepaid expenses. Companies sometimes prepay expenses for multiple months. When I mean prepay, a company will pay for the expense before they use up the expense or before it's incurred. These prepaid expenses are assets because a company has the right to use these in future without having to pay for them. Examples of prepaid expenses are typically prepaid rent, where a company will pay for multiple months of rent in advance, or prepaid insurance. Again, a lot of companies will pay for 6 months of insurance in advance. Again, these prepaid expenses are recorded as assets. Prepaid expenses are an example of a deferred expense. Now let's see how they record the expense when it's used up. As time goes by, the prepaid expenses get used up or expire. However, typically, the company does not record these expenses until the end of the period. The end of the period is when the company will prepare financial statements, and until the financial statements are prepared, there really is no need to determine how much expenses were expired or how much was the expense relating to rent or insurance. At the end of the period, the company will measure the amount of expired insurance or rent and then record an adjusting entry. Let's work an example. In this example, it says Jackson Company had the following events for its first year of operation. Only selected events are shown. On July 1st, year 1, Jackson Company pays $24,000 cash to lease their office for 1 year. The lease begins immediately. Then it says at the end of year 1, Jackson Company recognizes the rent expense for year 1, which is an adjusting entry. Then it says to use a horizontal financial statements model to show how each event affects the balance sheet, income statement, and the statement of cash flows. Before we work on the horizontal financial statements model, let's draw a timeline and see what's really happening here. I'm going to do that up here. So here's year 1. And it says on July 1st, which is somewhere around here, July 1st of year 1, the company paid $24,000 cash for 1 year of office rent. Now, as time goes by, this $24,000 will slowly get used up. We are now at the end of the accounting year, which is December 31st of year 1. And this is when the company is preparing their financial statements. We need to figure out during this period how much is the rent expense. As time goes by, the company does not measure and record rent expense every month. They just wait till they're ready to prepare their financial statement. So, can we determine how much is the rent expense? Yes, we can. First, we need to figure out how much time has expired between July 1st, which is when they entered into the contract and paid the $24,000, and December 31st. I always tell my students to use their fingers to count the months because when you're looking at the numbers or July, it's very deceptive. So let's start. Do we include all of July? Yes, we do, because the contract was entered into, or we signed the space on July 1st, which is the beginning of the month. So we do include all of July because we occupied that space. So we include July, all of July, that's 1. August, that's 2. September, October, November, December. If you kept up counting, that is 6 months. So we're looking at rent expense for 6 months. This period is 6 months here. Now we need to figure out how much is rent per month. We know that we paid $24,000 for 1 year, which is 12 months of rent. means it's $2,000 per month. Now we can figure out that if we have 6 months and it's $2,000 per month, our rent expense is going to be equal to 2,000 times 6, which is $12,000. That is your rent expense. So when we're doing transaction 2, the rent expense, we know it's going to be $12,000. Now let's go ahead and see how these transactions affect the financial statements. I'm going to use Excel to do this because it's easier and it'll calculate the totals. So for transaction 1, it says on July 1st, year 1, Jackson Company pays $24,000 cash to lease their office space for 1 year. How does this transaction affect the balance sheet? We know that cash is affected, so I'm going to have cash. What happened to cash? Cash decreased by $24,000, so I'll put cash as a negative number. Now, what else happened? We know that we have an asset called prepaid rent because this was for rent. We have prepaid rent of $24,000 where we don't need to pay rent for the next 12 months. So our prepaid rent increased by $24,000. That takes care of the balance sheet. Now let's look at the income statement. Did this transaction affect the income statement? No, it did not. Cash and prepaid rent are not revenues or expenses, therefore, the income statement is not affected by this transaction. Next, let's look at the statement of cash flows. Did this transaction affect the statement of cash flows? Yes, it did. Cash was affected, therefore, statement of cash flows is affected. Our cash had gone out of the company, so we had a cash outflow of $24,000. Now, what type of activity is this in the statement of cash flows? This was for prepaid rent. Rent is a day-to-day activity. It will become an expense when it's used up. So this is an operating activity in the statement of cash flows. That's it for transaction 1. Now let's look at the second item. The second item is our adjusting entry or end of period adjustment. We're going to recognize rent expense. We have rent expense of $12,000. So how does it affect the balance sheet? We know that expenses has the effect of decreasing retained earnings. Retained earnings is a stockholder equity item, and we're going to show that retained earnings decreased by $12,000 as a result of this increase in expense. What else happened? Well, now we know that we don't have $24,000 of prepaid rent anymore. We've used up some of that. We've used up $12,000 of the $24,000 prepaid rent. So our prepaid rent decreases by $12,000. And that takes care of the balance sheet. Now let's look at the income statement. Is the income statement affected by this adjusting entry? Yes, it is. We had an expense of $12,000. Our expenses increased by $12,000. So we're going to put $12,000 as a positive number under the expense column. This causes net income to decrease by $12,000 because nothing happened to revenue. That takes care of the income statement. Does this adjusting entry affect the statement of cash flows? No, it doesn't. There's no cash involved, so therefore the statement of cash flows is not affected. Adjusting entries never affect the statement of cash flows. That's it for this video. Please let me know if you have any questions.